Last night we were inches away from a potential new crypto crash, but we dodged it. How exactly did we avoid the bullet, and should we feel confident that the worst for Bitcoin is already behind us? Stay with us to find out. We also have to talk about the ongoing drama surrounding the Clarity Act crypto bill in the US, and we'll mention something very interesting related to Solana. Hit that like button, drop a comment, even a critical one, subscribe with the bell on, and let's get started. Late last night, the Federal Reserve decided to keep interest rates unchanged in the 3.5–3.75% range. The meeting was extremely unpredictable, but in the end, 9 out of the 12 participants insisted the rate should not be touched, while 3 pushed for an immediate 25 basis point hike. The crypto market went through mild turbulence before and after the meeting, with Bitcoin shaking around $64,000, but things could have been far bloodier if rates had been raised. When we talk about a potential rate hike, we need to understand a fundamental macroeconomic rule. The higher the base interest rate, the more attractive traditional financial instruments become, and risky assets like Bitcoin automatically lose part of their appeal. With higher rates, yields on government bonds, corporate bonds, and even simple saving products rise. Investors can suddenly get higher, guaranteed, predictable returns without taking on crypto volatility. And when returns on safe assets increase, capital naturally flows in that direction. That's exactly what could have happened if the Fed had raised rates by those 25 basis points. Institutional investors who hold massive crypto positions would have reacted instantly. Some would have reduced their Bitcoin exposure, others would have closed leveraged positions, and others would have simply moved capital into bonds because the risk-reward profile there would be better. Beyond the decision itself, investors closely watched the Fed chair's statement afterward. Kevin Warsh commented that the Federal Reserve is in a danger zone because economic signals are too mixed and inflation is still not fully tamed. According to him, keeping rates steady is reasonable in the short term, but he warned that if inflationary pressure intensifies in the coming months, the central bank may be forced to act much more aggressively. Warsh stressed that markets should not interpret the current decision as a guarantee of stability because the Fed is still not convinced the economy is in a safe zone. Comments like these keep the crypto market on edge. When someone of Harsh's caliber says future tightening remains entirely possible, it means one thing: volatility isn't going away anytime soon. If economic data in August and September show renewed inflation acceleration, the 3 Fed members who pushed for a hike could easily become 5 or 6, and that could lead to real tightening of financial conditions. Bitcoin is holding around $64,000 after the unpredictable Fed meeting, but that doesn't mean the bears are done ruling the market. Many analysts believe the cycle bottom is still ahead. Ali Martinez, for example, predicted it will happen between October 6th and 16th. Recently, Peter Brandt made a similar prediction, and we at Crypto Potato analyzed the historical 4-year cycle and also found that if history repeats, Bitcoin's bottom should arrive in early or mid-October. But until we reach that point, we may experience new brutal drops. Ex-user Pepesco predicted a potential crash to $49,000, while CryptoLens believes the final capitulation in October could come if Bitcoin plunges below $40,000. The biggest pessimist is the analyst known as Batman, who drew an interesting parallel between Bitcoin's current behavior and what happened in the fall of 2022. Back then, the main cryptocurrency collapsed to $16,000, but let's not forget that this was heavily influenced by the FTX disaster. Recently, exchanges like BitMEX and Bitmart announced they are shutting down operations, but these news did not trigger similar cataclysms in Bitcoin's price, so it's hard to imagine we'll see drama of that magnitude again. Our next story is tied to the ongoing saga around the Clarity Act, the bill meant to clarify which regulator oversees different digital assets in the US, but instead continues to create tension in the industry. According to reports, a close crypto advisor to Donald Trump rejected the latest proposal from a group of developers who want the bill rewritten to better protect innovation and limit regulatory overreach. Their argument is that the current version of the Clarity Act gives too much power to the SEC and could lead to new crackdowns on projects that aren't clearly defined as securities. Developers warn this could suffocate the growth of the American crypto ecosystem and push innovation abroad. Trump's advisor, however, was firm. The administration has no intention of supporting changes that would weaken the regulatory framework. He argued that the industry must accept that certain standards are necessary to prevent future scandals like FTX and protect consumers. He emphasized that the White House wants clear rules, not complete freedom, showing that internal debates around the bill are far from over. This puts the crypto sector in a delicate position. On one hand, the industry wants a lighter regime that encourages innovation. On the other, Trump's political circle seems determined not to allow an overly liberal approach. Ultimately, the Clarity Act may become one of the most important factors shaping the future regulatory environment in the US, and the market will be watching every next step closely. Our final story today is about Solana, and unfortunately it's not one of the optimistic ones. According to analysts, SOL may be heading toward a serious decline, potentially into the $50 zone if current negative signals continue to pile up. The main argument is a combination of technical weakness and shifting behavior among large investors, making the market more vulnerable to sharp corrections. One of the key indicators, worrying analysts, is the declining institutional interest. Data shows that large wallets are gradually reducing their exposure to Solana, which leads to lower liquidity and easier price slippage during heavy selling. At the same time, the technical picture looks tense. Solana is sitting below several important support levels, and the momentum that kept it above $70–80 is fading. Additional pressure comes from the derivatives market. Open interest in Solana futures has dropped sharply, which usually indicates traders are closing positions and avoiding risk. When this happens alongside declining spot liquidity, the market becomes extremely vulnerable to sudden sell-offs. This doesn't mean Solana is doomed, but it shows the market is entering a period where even small negative events can trigger sharper downward moves. That's all for today, team. Have a great and successful day, and see you tomorrow.